Question 9. As per the income tax law, gain arising on transfer of capital asset is charged to tax under the head capital gains. What constitutes transfer as per income tax law? Answer. Generally, transfer means sale. However, for the purpose of income tax law, transfer in relation to a capital asset includes sale, exchange or relinquishment of the asset, extinguishment of any rights in relation to a capital asset, compulsory acquisition of an asset, conversion of capital asset into stock in trade, maturity or redemption of a zero-coupon bond, allowing possession of immovable properties to the buyer in part performance of the contract. Any transaction which has the effect of transferring an or enabling the enjoyment of immovable property, or disposing of or parting with an asset or any interest therein, or creating any interest in any asset in any manner whatsoever. Question 10. What are the provisions relating to computation of capital gain in case of transfer of asset by way of gift, will, etc.? Answer. Capital gain arises if a person transfers a capital asset. Section 47 excludes various transactions from the definition of transfer. Thus, transactions covered under Section 47 are not deemed as transfer, and hence these transactions will not give rise to any capital gain. Transfer of capital asset by way of gift, will, etc. are few major transactions covered in Section 47. Thus, if a person gifts his capital asset to any other person, then no capital gain will arise in the hands of the person making the gift. If the person receiving the capital asset by way of gift, will, etc. subsequently transfers such asset, capital gain will arise in his hands. Special provisions are designed to compute capital gains in the hands of the person receiving the asset by way of gift, will, etc. In such a case, the cost of acquisition of the capital asset will be the cost of acquisition to the previous owner, and the period of holding of the capital asset will be computed from the date of acquisition of the capital asset by the previous owner. As regards the taxability of gift in the hands of person receiving the gift, separate provisions are designed under Section 56. Question 11. I have sold a house which had been purchased by me 5 years ago. Am I required to pay any tax on the profit earned by me on account of such sale? Answer. House sold by you is a long-term capital asset. Any gain arising on transfer of capital asset is charged to tax under the head capital gains. Income tax law has prescribed the method of computing capital gain arising on account of sale of capital assets. Thus, to check the taxability in your case, you have to compute capital gain by following the rules laid down in this regard, and if the result is gain, then the same will be liable to tax. Question 12. Is any capital gains exempt under Section 10? Answer. Section 10 provides list of incomes which are exempt from tax. Amongst these, the major exemptions relating to capital gains are listed below. Section 1033. Long-term or short-term capital gain arising on transfer of units of unit scheme 1964 U.S. 64 transferred on or after the 1st of April 2002. Section 1037. An individual or Hindu undivided family HUF can claim exemption in respect of capital gain arising on transfer of agricultural land situated in an urban area by way of compulsory acquisition. This exemption is available if the land was used by the taxpayer or by his parents in the case of an individual for agricultural purpose for a period of 2 years immediately preceding the date of its transfer. Section 1037A. An individual or Hindu undivided family HUF can claim exemption in respect of capital gain arising on transfer of land or building or both under land pooling scheme under the Andhra Pradesh Capital City Land Pooling Scheme Formulation and Implementation Rules 2015. This exemption is available if individual or HUF was owner of such land as on the 2nd of June 2014, inserted by the Finance Act 2017 WEF the 1st of April 2015. Section 1038. Long-term capital gain arising on transfer of equity shares or units of equity-oriented mutual fund or a unit of a business trust other than a unit allotted by the trust in exchange of shares of a special purpose vehicle as referred to in Section 4717 will be exempt from tax if the following conditions are satisfied. The asset transferred should be equity shares of a company or units of an equity-oriented mutual fund or a unit of a business trust other than a unit allotted by the trust in exchange of shares of a special purpose vehicle as referred to in Section 47. The transaction should be liable to securities transfer transaction tax (STT) at the time of transfer. Such asset should be a long-term capital asset. Transfer should take place on or after October 1, 2004. Note: any long-term capital gain arising from a transaction undertaken in recognized stock exchange located in an international financial service center shall be exempt from tax. Such exemption is available if such transaction is undertaken in foreign current and even if no STT is paid on such transaction. Long-term capital gain exemption on transfer of equity share acquired on after the 1st of October 2004 shall be available only if the acquisition of share is chargeable to STT. However, the exemption shall continue in genuine cases where the STT could not have been paid, like acquisition of share in IPO, FPO, bonus or right issue by a listed company, acquisition by non-resident in accordance with FDI policy, etc. inserted by Finance Act 2017. Equity-oriented mutual fund means a mutual fund specified under Section 1023D and 65% of its investable funds out of total proceeds of such fund are invested in equity shares of domestic companies. Question 13. At what rates capital gains are charged to tax? Answer. For provisions in this regard, check tutorials on tax on short-term capital gains and tax on long-term capital gains. Question 14. Are there any bonds in which I can invest my capital gains to claim tax relief? Answer. Yes. As per Section 54(c), you can claim tax relief by investing the long-term capital gains in the bonds issued by the National Highway Authority of India or by the Rural Electrification Corporation Limited. The investment should be made within a period of 6 months from the date of transfer of capital asset, and bonds should not be redeemed before 3 years. This benefit cannot be availed in respect of short-term capital gain. Maximum amount which qualifies for investment will be 50 lakhs. Thus, deduction under Section 54(c) cannot be claimed for more than 50 lakhs. Question 15. What is the meaning of stamp duty value and what is its relevance while computing capital gain in case of transfer of capital asset, being land or building or both? Answer. Stamp duty value means the value adopted or assessed or assessable by any authority of a state government for the purpose of payment of stamp duty. As per Section 50(c), while computing capital gain arising on transfer of land or building or both, if the actual sale consideration of such land and or building is less than the stamp duty value, then the stamp duty value will be taken as full value of consideration, i.e., as deemed selling price, and capital gain will be computed accordingly.